Hi, and welcome to another episode of Mazars COVID Talks, a podcast about pandemic resilience aimed at supporting business survival by directing organizations to resources and embedding a culture of preparedness. It is April 17th, a Friday, and my name is Tashonda Hagerbrook. I'm a senior consultant within the organizational resilience practice here at Mazars USA.
Hi, everyone. I'm Alisha Jernak. I'm a senior manager in our entrepreneurial business services and advisory group.
And today we're going to be doing things a little different. Usually Alisha and I will kind of drive a conversation around certain topics, and we had an offer from our financial services group to come in and kind of lead a conversation today. So we're really interested in hearing from Charles Abraham and Sam Pizzichillo. And Sam, do me a favor. Am I saying your name correctly when I said pronounced your last name?
Close. Sam Pizzichillo.
Pizzichillo. Okay, there we go. So I really do that and not make sure we got it right beforehand, because it's my way to hand it off to you. That's more of what it was. Just butcher your name and then we get right into it. No, but really, I want to let you guys just introduce yourselves and kind of share with us some of this information, because Sam and we've been kind of talking about this stuff for a couple of weeks, that you really have some great content to bring to our listeners.
Excellent. Thank you, Tashonda. Thank you, Alisha. I am Charles Abraham. I'm currently the financial services practice leader at Mazars USA. First and foremost, I hope that everyone is out there staying safe and keeping healthy. A special thank you to all of those on the front lines, our healthcare workers, those essential workers, those working in post offices, delivery services, restaurants managing takeout orders. Thank you. Thank you for everything that you do for us. So we're going to start this conversation with the broker-dealer sector, and I want our listeners to be aware that the information that we're providing is updated through today, April 17, 2020. And we'll continue to keep you updated through additional podcasts and webcasts as more information comes to light. So with that said, I'm going to turn it all over to Sam to kick us off.
All right, thank you, Charles. And my name is very long, so I'll repeat it again. I'm Sam Pizzichillo, and I'm a senior manager in Mazars USA's financial services audit practice. And a focus area of mine is the securities brokerage industry. I work with broker-dealers ranging in size from very small to very large, and including fixed income and equity proprietary traders, commission brokers, and broker-dealers that participate in underwritings and private placements. The past 2 months have been very difficult for a lot of broker-dealers. Significant volatility and liquidity compression in the financial markets has created hardship and economic uncertainty for a lot of firms, especially the smaller ones. And we've worked with many of our smaller clients to apply for the Paycheck Protection Program, which was established under the CARES Act on March 27th. At this point, I think most of us are pretty familiar with the guidance around the PPP, but just in case anyone isn't, I'll give a quick overview. Under the PPP, eligible companies with fewer than 500 employees can apply for a loan which is based on 2.5 times monthly average payroll costs, up to a maximum of $10 million. Interest rates associated with PPP loans are capped at a maximum of 1%. One of the guidelines that's most interesting about the PPP loans is that qualified expenses incurred during the 8-week covered period following the loan date can be forgiven as long as the employer maintains previous employee headcount and compensation levels. The expenses that count toward loan forgiveness include payroll, rent or mortgage interest, and utilities. But payroll must constitute 75% of the total 8-week covered period costs. Other key features of the PPP are that no collateral or personal guarantees are required, since all PPP loans are federally guaranteed by the SBA, and loan repayments that are not forgiven are deferred for 6 months and mature in 2 years. The current news headline is that the $349 billion of funds has run out. Now, there is talk in Congress about working toward passing an additional round of funding, but at this point, nothing is official.
So thanks for that, Sam, especially about the new headlines, right? You've mentioned that we've assisted a lot of broker-dealers with applying for the PPP loans. But a question that I know has come up is how do they treat that for net capital purposes under the regulatory filings?
Well, that's a great question. And you're right, it is one of the first things that our clients think to ask. To address this question, FINRA posted an FAQ related to regulatory relief due to the coronavirus pandemic. According to the FAQ, if a member firm has included a covered loan as a liability on its balance sheet, then the firm is allowed to add the forgivable expense amount back to net capital to the extent that the firm has recorded the associated costs, which I mentioned include payroll, rent or mortgage interest, and utilities. But the add back is limited to the amount of the covered loan liability. The firm may also exclude the covered loan amount from AI during the 8-week covered period. After the covered period, the firm may exclude from aggregate indebtedness the forgivable portion of the loan that is allowed to be treated as an add back for net capital.
Interesting. Can you also just take us through what other topics and relief that the FAQ provides? I think that might be useful for listeners.
Well, based on the FAQ, a firm who meets the exemptive provisions in SEA Rule 15C33 or who files a Part 2A focus report will be provided a 30 calendar day extension for submitting an annual report if their fiscal year ends between January and March 2020, and those firms will be provided a 10 business day extension for submitting any focus reports for periods ending in February through April 2020.
Got it. Thank you, Sam. So FINRA has also been putting a lot of focus on business continuity planning. Since a lot of broker-dealers have had to work remotely, have employees work from different locations, et cetera. So recently, FINRA had also put out a regulatory notice as a reminder to member firms to make sure that they review their BCP policies. And the reason for that was a lot of BCP plans that have been put together may have been boilerplate or may not have addressed the risks that have obviously been in place because of the pandemic. It also notes that broker-dealers should address some of their supervisory procedures. For example, if you have employees working remotely, especially associated persons, how do you supervise them, as well as consider the cybersecurity considerations that you need to have in place with a lot of people working remotely, a lot of data that needs to go across, and a lot of confidential information out there.
That's right, Charles. And the notice that you talked about also sends the requirement to update Form U4 regarding the Office of Employment Address for registered reps who temporarily relocated due to COVID-19. And similarly, firms are not required to submit a Form BR for temporary office locations or other arrangements because of COVID-19. Additionally, according to the FAQ that I spoke about earlier, if a member firm is required to activate its business continuity plan in response to the pandemic or any other emergency event, they're encouraged to notify their assigned FINRA risk monitoring analyst to discuss the plan and any disruptions to operations. The FAQ also addresses qualification exams and individual registration, including extending expiring qualification exam windows until May 31st, 2020 for individuals who are designated to function as principals pursuant to FINRA Rule 1210.04, and permitting firms to electronically file an initial or transfer Form U4 without obtaining the individual applicant's manual signature pursuant to FINRA Rule 1010C, provided that certain conditions are met.
All right, I'm kind of impressed you knew all those rules. So I just want to mention one more point related to broker-dealers. So the SEC had come out with the Consolidated Audit Trail implementation. Knowing the severe stress that's on various infrastructure and the constraints that people have, they said that they would not recommend enforcement action against participants who cannot comply with these rules. As of right now, the relief is extended through May 2020, but it could be extended.
And Charles, with all that's going on, we're getting calls day in and day out from our clients with questions, and we're hearing a lot of common pain points. I just want to make sure everybody knows we're here to assist however we can, whether it's related to a PPP, a technical accounting or tax question, or any IT matter. So if anyone needs assistance, feel free to send us an email and we'll be sure to get right back to you.
All right, great. So thank you for that, Sam. I do want to turn the discussion a little bit over to the banking sector. So as I'm sure all of you know, the banks, they perform a critical role. They provide liquidity to customers. We can get personal loans, home equity lines of credit, mortgages, car loans, etc. From banks. But at the same time, if I'm depositing my money with a bank, I want to make sure that my bank is going to be around. So banks are providing that liquidity to me as a borrower. At the same time, it needs to offer me some stability, some assurance as a depositor to make sure, hey, I'm still going to be around. So from our conversations with a lot of banks in this space and all sizes of banks, they're also facing some key issues. So some of the questions that a lot of banking senior management have gone through is, how do they serve their communities via their branch network while at the same time keeping their employees safe? A bank with a really extensive branch network, it's important in certain communities that don't have access to digital resources to access their money, to send wires. They need to do it face-to-face. So banks are always looking at that and trying to balance that against, how do we keep our employees safe? In a branch that normally has 100 employees, we don't want to have 100 employees in that space. We might need to reduce that to 40 or 30. How do we run a bank that way with the same regulatory constraints, with the same segregation of duties constraints that a branch needs to have? Secondly, there's certain banks, smaller ones, that may not have fully invested in technology. So how do they augment their digital platform to assist customers? There are also banks who have a demographic of people that don't have access to digital technology, right? So how do you train customers in that scenario? Also, as we know that there's been a significant impact to borrowers around the country and around the globe, a lot of people are having trouble making their bills, making payments. How do banks deal with collections for borrowers that have significant issues in paying their obligations? How do they account for it under the accounting standards? How do they account for it under regulatory standards? Also, the best banks that are out there, really the banks that are really invested in their communities, are talking about how do they proactively work with borrowers to ease some of those cash flow concerns. So while the PPP initiative was still active, and I believe that it'll probably have more funds in it shortly, the banks are considering, do they want to enroll as an SBA lender? Do they want to be an SBA lender? Do they want to participate in this program?
Thanks, Charles. Can I ask you to give a top 3 list of items that PPP lenders should be considering?
So I definitely have a list that's longer than top 3, but if I have to limit it to top 3, here's what I think, right? And I think that this list can be applicable to most institutions with a new lending program. So first on the list, I'd say it's governance and oversight. Banks have to ensure that their risk assessments, their controls and governance address the changing environment, and it needs to address the risk profile of the new program. Lenders who are first-time SBA loan providers have more of a learning curve. Now that doesn't also address the fact that a lot of banks that have been SBA loan providers still had a learning curve, because the PPP, when it was rolled out, it was done in a short period of time. Not all the kinks were worked out initially. So these lenders have to carefully implement the changes and also challenge areas in governance where there has been no changes. The banks have to ask the question, is it appropriate that our governance didn't need to change at all with the new loan program? So that's number one. The second item is compliance. Are the banks in compliance with the SBA lending policies? Have they complied with the Bank Secrecy Act, the anti-money laundering regulations? If the new program increases exposure to fraud and suspicious activity, which again, with a high volume of loans, that's always a consideration that banks need to have, does the bank's monitoring address those new exposures? The third in my top 3 would be quality assurance. Once the loans are on the books, does the new loan program act the way that the bank expected it to act? Are there any adjustments needed to risk assessments or the risk profile? You have to ensure that the quality assurance policy that's in place meshes between operations, risk and compliance, and internal audit considerations for the new program. So while I said top three, as a bonus, I'm going to add a fourth one, right? And the fourth one is regulatory considerations. There's regulatory considerations that's specific to the PPP lending program. In order to incent banks to be able to lend under the PPP program, the Federal Reserve has issued a lending facility. There's a lending facility for banks that are providing loans under the PPP. In addition, regulators like the OCC, the FDIC, the Federal Reserve issued an interim final rule on April 13th. I believe it was April 13th that it hit the Federal Register, to neutralize, yes, the word that they used was to neutralize the impact of lenders participating in the program. So they wanted lenders to participate in the program and to have no negative impact on the regulatory capital that they hold on their books. So it allows banking institutions to exclude these loans from their leverage exposure, from the community bank leverage ratios, if that's applicable, and average total assets. In addition, the loans that are generated under the PPP have a 0% risk weight under the regulatory capital rules. We're going to have a lot more details on the regulatory impact on the Mazars website, and we'll make sure that we put a link on the podcast page as well, so you're able to see that.
Charles, to stick with the regulatory, the regulatory theme, I've also heard that the CARES Act has an impact on how banks measure their losses. Can you give us a brief update on that?
Absolutely. So, Sam, for not being a part of the banking group, that is a great question. So the response can be an 8-part answer with 3 subsections each, right? But before our listeners go and pour themselves a stiff drink, I will limit it to a very short answer. We will, as I said before, with the regulatory capital rules, we will have a full presentation available on the website, and we'll add another link to the impact of the loan loss requirements for banks. So a brief overview on the loan losses. In the U.S., banks have traditionally been under the incurred loss model. And with the Accounting Standards Update, or ASU 2016-13, banks were required to start moving from incurred loss model, which is to say, what are the losses in my portfolio today, and to move to a current expected credit loss model, or CECL. So what CECL basically does is it requires that a bank has to be able to assess the losses, not just today, what I've incurred, but also what do I expect as losses in my portfolio. So in general, the application of CECL would lead to significant increases in a bank's loan loss reserves, as it's a fundamental difference in how a bank looks at their loan losses. So with the issuance of the CARES Act, which Sam spoke about, Section 4014 of the CARES Act, now I'm sounding like Sam. Section 4014 of the CARES Act allows banking institutions to not have to comply with the CECL requirements until the earlier of December 31, 2020, or when it's no longer a national emergency under the National Emergencies Act, meaning the COVID-19 is no longer a national emergency. In addition, banking regulators have provided an additional 2 years to transition the CECL impact to the regulatory capital rules. So previously, banking regulators had a 3-year transition period. With the additional 2 years, you have a total of a 5-year transition period to transition that tremendous impact of CECL into your regulatory capital. I'll mention one other code section as long as you're all still with me, which is Section 4013 of the CARES Act. And that allows financial institutions to suspend loan modifications from being deemed to be troubled debt restructurings, and including impairment for troubled debt restructurings under the accounting standards. So to take a quick step back, banks want to do the best things for borrowers in order to get obligations paid, right? So if a borrower is having trouble making payments, banks will generally try, with most portfolios, to try and restructure the loan, either reduce interest rate, reduce principal balances, increase the term of the loan, etc., to get the borrower to pay as much as possible, but ease the cash flow considerations. Under the accounting standards, you have to look at each modification like this and say, is it a concession? Meaning, have you actually provided them a concession? And secondly, are the borrowers in financial difficulty? Meaning, if I walked into a bank and said, listen, I'm going to go to the bank down the street unless you reduce my rate, that might not be because I'm having a financial difficulty. That might just be competition in the marketplace. So what regulators have said under 4013 of the CARES Act is they've basically said, listen, the loans that are deemed to be modifications, you need to modify these loans because of a COVID-related matter. You don't have to categorize them as a troubled debt restructuring, including the additional impairment that you take for accounting purposes. So there's a few criteria that a loan needs to have in order for it to fit this type, right? Number one, the loan should not have been more than 30 days past due at December 31, 2019. And the real purpose for that is you don't want a bad loan to now not be considered a troubled debt restructuring now. Secondly, the borrower should have had a real impact because of the pandemic. It should be, you should be able to clearly have a clear connection to COVID-19. And third, the loan modification should have been made between March 1st, 2020 and the earlier of either December 31, 2020 or 60 days after the National Emergencies Act declaration of this COVID-19 pandemic being declared an emergency. So I know I said a lot there, but there's been a lot of relief provided both from CECL as well as from TDR accounting for banks to be able to incent them to work with their borrowers.
Thanks, Charles. And just to cap off our discussion on the banking sector, what's your outlook for the banking sector over the short term and in the midterm?
So I will caveat this by saying I definitely do not have a crystal ball, right? But I think the pandemic has exposed some key issues for financial institutions. I'm of the belief that a successful bank is one that caters to the needs of its community, right? And banks have to constantly evaluate what value am I providing to the demographic that I serve, and I have to balance that with the profitability that I need at shareholder value. So key issues that I see in the short term are how are banks, especially smaller banks, able to address their short-term stability and viability in the face of borrower defaults? The borrowers might not be able to pay. Do they have enough regulatory capital? Do they have enough cash flows to continue to stay in business? How can banks reduce their operating costs to conserve cash flows, but still support the communities that people are dependent on an extensive branch network? The pandemic, they've taught us the need to have to be able to work remotely, right? It's taught us the need that you need to be able to access your files in a secure manner, using the internet, using electronic means. So if the future of banking is digital, how does a community bank or a regional bank respond to that? Do you build it? Do you buy it? How do you deal with legacy systems? A lot of banks have a lot of legacy software in-house. Do you layer on more? Do you build it from scratch? Do you have the time for that? So I think there's a lot of questions that banks need to ask. I think in the near term, you're going to see financial institutions struggle. There's going to be some takeovers of not so well capitalized banks by regulators. You might also see some mergers and acquisitions with larger, more well capitalized banks. But I will say that in the midterm, I don't think that the future is just built off of the largest banking institutions. I do think that we're going to see banks embrace investing in their digital platforms. We're going to see banks maintain more regulatory capital. I think the trend since the 2008 financial crisis to now is that banks are significantly better capitalized now than they were back in 2008. But I also think they will see a lower number of banks weighed down by the legacy systems. We'll see more fully digitized banks and probably stronger partnerships between banks and fintech firms to give the consumers the best of both worlds. So, like I said, I started with I don't have a crystal ball, but then I gave you my prediction anyway. So I think we're coming up on the time for our podcast. So I would want to turn it back to Tashonda and Alisha for final thoughts.
Well, first thing I'd like to say is thank you, guys.
Yes, thank you very much. That was awesome.
Yeah, those 4 wrap-up points that you had mentioned as you were talking about banking, and you talked about the governance and oversight, risk and compliance, quality assurance, and the regulatory considerations for the PPP. I'm hoping that our listeners realize, it's not just a wealth of knowledge and conversation here, but we're, actively putting together, service options to really help institutions with this stuff. So we're not just here talking about it. And we appreciate Sam and Charles stepping away from all of the work that they're doing to come join us for that message. Okay, guys, so you know what time it is. We talked about doing a note on personal preparedness, and this is where our listeners will get to learn something a little more personal about you guys. But what are you doing to cope, to stay prepared, yourselves, your families, however you'd like to share?
Sure. So I will go first, just because I like interrupting Sam. The reality of the situation is that there's a lot of people struggling, right? So, we should always consider how we can help. But I know my next sentence is going to sound like I'm conflicting that, but I also think that people need to take some time for themselves to try and be present. One of the key lessons for myself was that to try not to multitask. I've got 2 young kids at home, so for me not to be able to multitask with everything else that's going on in the world is to try, when I have the ability now to spend some time with them, because I am working from home, is to really be present. Now, to say something conflicting with that, sometimes I do like ignoring them, because on Saturday mornings I'd like to take a ride on my motorcycle where you really can't multitask, right? You're basically just spending time on that. So my suggestion to everybody is be present. Take some time for yourself and balance that against trying to see how you can help others who are struggling. And Sam, I apologize for interrupting. Go ahead.
No, on a personal level, I completely agree with you, Charles. I think it is getting tough to stay locked in the house and to maintain social distancing, but I'm doing my best to keep my days structured so I can be productive professionally, but I'm also trying to enjoy some of the extra family time with my wife, Christina, and my son, Lucas, who will be turning 2 in June. And when it's possible, I agree. I think it's very important to enjoy some of the sunshine outdoors on some of the warmer days and maybe take advantage of the flexibility and make up some of the work later in the evenings. So I am definitely doing my best to stay busy and maintain balance.
I love it. That's very great and very thoughtful notes on personal preparedness from both of you. So thank you, guys. Any last hoorah note for our listeners by any point from anyone? Sorry.
No, all good. I think you'll hear from us soon as there's more information out there.
That is the plan. So we will come back together again. Thank you to our listeners. Have a great
Thank you.
Thank you.
For more information on the topics discussed today, visit us at mazarsusa.com/COVID-19. That's MAZARSUSA.com/COVID-19. Remember, all information shared on Mazars COVID Talks extends from reputable sources. The views expressed here are meant to serve as suggestive guidance based on the knowledge and expertise of the co-hosts and guests. Thank you for joining us.